How's it going, guys? And welcome to subsection 5 of section 3, where we deal with Wyckoff. So if you haven't, you must have gone through all these subsections to this point and all the subsections of each section before you watch any of these videos, because they are all a buildup of each other. And for those of you that are here, I'm going to repeat it again, but as long as you understand this, that is where real growth comes from, because repetition will breed the confidence in you to be able to continue doing this, okay? Again, what is Wyckoff? Wyckoff is nothing more than the creation of liquidity, the manipulation of that liquidity, and the mitigation of those manipulations to continue in a given bias and given order flow direction. As well as that, it is complemented and also similar to the ideas of structure being put in by way of candlestick structure, which breaks structure and has to come back to, again, mitigate certain points, thereby leaving behind mentfx blocks and areas of that nature, as well as overall order flow structure, which is going to be put in with shifts in structure, which again are nothing more than the transfer of all the cells in a certain range or area to buys. Now, as we understand, these snowflakes or these specific areas occur absolutely everywhere in any market in any time frame across multiple time frames. The only difference between each of them is one, that you're going to have schematics that form over a longer period of time, that you're going to have trades that last longer periods of time, and three, that when you get involved on lower time frame areas, you need to partial and manage a lot more aggressively because of the fact that smaller schematics can be part of much larger schematics and do not have to be the last possible area or the last point of supply or last point of support or the test of a UTAD or a spring in every case, which is why, again, you learn about the importance of partialing over time. And that's how we breed and grow into getting some of the best RR trades. So in this specific video, we're going to talk a little bit about reaccumulations and redistributions. If you recall, back to the first video that we had on the overall section 3 of Wyckoff, we spoke about, or second one, I'm not sure, we spoke about type 1 and type 2 schematics, and ultimately how the type 1 schematic is going to be the big moves down, the stop in price, right? Whether it's a mini, like it's a larger stop in price, you have the selling climax, AR, ST, STB, spring of some sort, right? The breaks above, maybe a test before, then the breaks above, the buybacks that might have accumulations within them. That's usually how I get involved, and the continuation significantly higher, right? Along the way. This can be on a higher time frame. If we zoom in onto the lower time frame of this higher time frame, we're going to see accumulations and distributions occur in many of these areas. Some are uglier than others. Some are more predictable than others, such as these with potential supply zones, where you look for guaranteed confirmation to get into this. Even though you know that it might not be bearish for a long time, you can be part of the move that gets you below a potential important structural point. So as we understand, Wyckoff will occur everywhere and happen a lot of the time. Now, one of the ways that we basically understand which Wyckoff schematics we can get involved in is, one, we understand what a type 1 and type 2 is and how the best ones kind of look, how they form for us, why the liquidity grabs happen, and how they often play out. Two, the reason we are able to get involved on them is because we have specific areas of price where we expect certain things and certain price action to basically show us that it wants to continue going in a specific direction. Now, what's interesting about the way we trade and the way other Wyckoffians trade is other Wyckoffians that trade strict Wyckoff use a variety of other tools with Wyckoff, like volume and like understanding reaccumulations and redistributions, because what they do using those is understand how the moves in a Wyckoff schematic being confirmed or correlated with volume, allow them to tell whether something might be transforming into a reaccumulation or redistribution. But what they're also doing as they're doing that is their care for kind of the other price action that exists on the left, or all potential areas of supply and demand that exist, stops to really matter, right? And what they do is, instead of looking for something of this nature, like this, right, and looking for the sells off those potential mitigations, as we learn in section 1 and section 2, what they do is they watch price. And as they see price approaching certain things, maybe undergoing a certain number of accumulations or liquidations, they use volume correlation or creek correlation, which is ultimately something that occurs in some reaccumulations, to determine whether an overall move is a distribution, right, or a reaccumulation, which is basically a distribution that becomes an accumulation. Now, Why is this not important for us? There's a very big reason, and it's because we are not strict Wyckoff traders. We do not look at volume because we don't care about it, because we understand that we can confirm bias and we can confirm momentum using the candles that form and using the liquidation processes of the only two types of schematics we need to learn about. Type 1 and type 2 schematics, which are just flipped for accumulations and distributions. Now, when they do this, usually I've noticed that many Wyckofians do not actually use, potential areas of supply and demand in their overall anticipation of price, and instead use the actual movements in price to determine exactly what it's undergoing, whether it's a distribution and they can sell here, or if it was an overall accumulation, they should be buying here. Because remember, an accumulation and distribution look very similar. One of the largest problems that many Wyckofian traders or students run into is that as they see something like this forming, right? You might all agree this is a distribution now. I would too, right? They see this form, and what they expect is this is supposed to go lower, and they might sell here, or they might have already sold, and instead what you'll see is something of this nature, right? And the reason this happens is because price undergoes what we call a reaccumulation. This is a very normal thing that happens. And what's actually happening is the way you label one, and do not get too confused by this, but I'm going to show you because I want to explain this to you guys, is that, again, you will have your stop in price of some sort, your PSY, follow that up to your buying climax, all good, follow that down to your AR, follow that up to your ST, potentially UT, because remember, the UT only has to take out the ST, does not have to take out the buying climax, follow that up to your UTAD, right? And now after this point, you have a few very interesting things that happen to a schematic. Either you have the breakdown and you have the test, which takes you to completely new lower prices down lower, or you have this big move down that actually functions as its own spring, right? And as this spring forms, what you actually have is you have the break above here, and you have the test that continues higher. This is what, in general, a reaccumulation looks like. Now, more often than not, instead of all this happening, what you'll actually have to confirm some reaccumulations, because like I said, they use volume correlation to confirm the reaccumulation or distribution to see if it's actually occurring, or they'll use what we call a creek. And that will often happen like this. You'll undergo a normal distribution, buying climax, AR, ST, UT, right? Or even a UTAD, doesn't matter. So let's say PSY, whatever, BC, AR, ST, UT, and then what they'll usually see is instead of one of those larger breaks down, what they'll see is a creek. This creek begins to draw a channel, and the channel gets manipulated. The manipulation of that channel, maybe a little bit less, there we go, is what they call the spring, and now they'll look for entries to go higher. Now, what's interesting about what they're doing here, right? So again, remember that this is a distribution that becomes an accumulation, therefore it's called a reaccumulation. And they confirm this using their variety of confirmations without using what we do. Now, the fact that we, as institutional order flow traders, as well as Wyckofian confirmation traders, the fact that we use these areas of supply and demand that show us potentially unmitigated zones and potential reversals in price or continuations in price based on what we're expecting, we are able already to expect distribution or accumulation to occur. And what do I mean by that? Strict Wyckofian traders only confirm and say, okay, we have an accumulation or distribution based on their factors. Our factors, on the other hand, that tell us if there's a distribution or an accumulation happening are based on the factors of higher time frame structure, so all of section 1, and on unmitigated section 2. And what bases our entries is the only thing we care about is if we have this zone, for instance, and price is coming to it, the only thing we care about, however price is getting to the zone, we only care about accumulations happening. So whether price did this before and then drop down amid an accumulation does not bother us. Yes, we will take this into account and potentially look to partial at certain supply zones higher up, but that is part of partialing, part of liquidity. So it's not a big deal. But all we really care about is the overall price action in our zones. Because we're not just looking at overall price and looking at this and going, all right, I think it's an accumulation until, oh, it's a distribution, let's sell it, right? We are not changing our bias based on how it is given to us. And we're not using volume to confirm or deter us from trading a certain thing. Instead, we are using overall order flow and the notion of it and the biases that we preset using the higher timeframes and the lower timeframes and unmitigated zones to determine preemptively whether or not we want to see an accumulation or distribution. So just like I showed you guys in the past video, and as I will show you guys right now, for instance, as you guys know, I trade EU. Let's just go to a 1 hour chart, make it somewhat easier. Okay, actually the 1 hour chart's a little bit ugly. Let's go to the 4 hour chart. Actually, we'll take the 15-minute chart. That's fine. So as I explained to you guys earlier, forget about the way price has been delivered and just think about what price is doing here. As we see price shifting in structure and giving us bullish price action, we have certain unmitigated zones that we want to see price tap into before giving us bullish price action. And because we already know that, when price gets to that zone, which it does here, we are already preemptively expecting accumulations. We do not give a shit if there is a redistribution that happens there. Because if the redistribution happens, we're not going to see the confirmation we need to see for the accumulations. Okay, so I hope this is kind of getting through. So something else that I'm going to show you that's actually very interesting concerning this type of way of thinking about price is that let's consider a re-accumulation one more time. So again, remember, it's a distribution, buying climax, AR, ST, right? An upthrust. Then some kind of creek that is made by a channel of some sort, okay? There's a channel. A spring, right? That gets below lows, whatever it may be, takes out lows of the creek of some sort, right? This is the way people think about reaccumulations. Breaks higher, right? Comes back to test it, right? Breaks higher, maybe LPS, and then takes off and goes significantly higher, and that's a markup, okay? This is a reaccumulation. Now, what you'll notice that's actually really interesting about this is that if we for a second forget about the price action over here, all this nonsense that was distributing, and just look at the price action inside of this, what do you notice? If you just study the price action here, what do you see that's interesting about this? Well, you'll see that we're actually undergoing a mini accumulation within the re-accumulation. What do I mean by that? If you don't pay attention to all this previous price action and notice how price comes down, makes your big back up, comes down, makes another back up, comes down, makes your selling climax, AR, ST, creating relatively equal lows, doesn't get above here, doesn't have to, it can, but it doesn't, ST and B getting just below here, okay, spring, the break above that shows you that it wants to go higher, there's a sign of strength, the move back down to create the test, and the break higher, maybe a backup, LPS, whatever it is, and the continuation higher. What you actually have when you forget about what's here, and you zoom into just the price action right, pretty much here. Actually, even further. Okay, we can't really go further, but if we pretty much delete everything on this side of price action, just like this, and we make that opaque, there we go, then you notice that all you have is an accumulation. And the important thing about that is if you know that that's an accumulation, and on top of that, you have an area in the past that you're using as a place where you're expecting mitigation to occur at, and this happens, now you are confirmed to run in that given direction. As you get involved in those buys, you begin to partial above highs, into potential what? Boom. Into potential supply zones. Whoops. Into potential supply zones. So now you know you're partialing above liquidity, above supply zones, and into potential significantly higher price action. Why? Because that price action is based on, most likely, something of this nature. Right? And this move back in was actually that re-accumulation. So even though there was a re-accumulation here and all that stuff happened, so now you can kind of see it like this. Right, so like this. Okay, hold on. So you have a big move up, a big move down, right? So you were bullish, still bullish, boom, right? Okay, wait, that's bad. Bullish, still bullish. All right, there we go. Bullish, right? So we're putting in higher highs. We're expecting a move back down into what? A potential area of, so let's imagine this was a little bit higher, just like this. That's fine. There we go. Something like, okay, but you know what I'm saying. There we go. All right, so if we have this as a potential area of supply, we don't care that price is distributing here and then becomes an accumulation because we're already expecting it to be an area where we're expecting buys from. So why would we give a shit about the fact that it's distributing here? Yes, it is distributing. And there possibly are, no shit there are, distributions that will happen here distributions that will happen here that you can use to be involved in to potentially the demand zones in here and the demand zones deeper. But because you're already anticipating a given bias and order flow direction, you don't need to know anything about reaccumulation or redistribution because they're nothing more than influences to confuse you. Because you've already understood that Wyckoff will not only happen everywhere, but it will also happen on any time frame, back and forth, because there's a constant transfer of buys to sells. And sometimes there's more buys to sells, and sometimes there's more sells to buys. And the only way that we can use that to confirm ourselves in is by confirming it off of base areas like that. So this is why reaccumulations and redistributions do not matter to us. The creeks, none of that stuff matters to us. If you want to find a way to use creeks to use as a extra confirmation for your own entries, and you see that it works every time you see a creek, use it by all means. However, the fact that you understand how Wyckoff is drawn overall with the liquidation of lows and everything of that nature, and you have zones that you're expecting that from, is all you need to potentially look for confirmations into given moves, right? And that's pretty much it. So if we like, for instance, let's get rid of all this. None of that's important anymore. I know I can make that easier on me, but there's no point. So what I mean by that is this overall, you could have maybe on this higher time frame been viewing it as a potential accumulation. Now you can notice that after the fact, we had lows, liquidated, we had the move up, and then we had the breakdown. So overall, this became a distribution. But if you knew that you were breaking down in structure already, and you had certain areas mapped out by way of either mentfx blocks, right? Or even final buys before sells, or even refined wicks, so last buys before real sells, you'll see that we already were expecting sells from there. So even though this might be an accumulation or a redistribution, and we don't know which one it is, the second you get to a lower time frame, you see the distribution on that time frame. So instead of looking at all this and trying to map out whether or not the momentum is moving price into a way that might make it a redistribution, or if it is an accumulation and you're not sure, all you do is you zoom in on the price action of the area that you're actually expecting price to move from, and now the actual story changes. And what I mean by that is, again, now you can follow this. Buying climax, AR, ST, sign of weakness in phase B, upthrust, UTAD, price begins to break down. Now this schematic will only be validated down here, but that doesn't mean that on the way down, as we break candlestick-based structure, there aren't going to be new supply zones that will act as re-entry areas off of even lower time frame confirmations. Okay, and again, I know we're on the lower time frames right now, but the exact same thing is applicable off of even higher time frames. So notice how when price does get below here, it does it impulsively, comes to test some areas, breaks impulsively, leaves behind what? Supply zones, comes to test them, and breaks down impulsively. And again, if you wanted to confirm, there are areas in here that act as confirmation entries off of distributions. And similarly, you wouldn't be expecting this distribution right here to become a reaccumulation. You wouldn't expect this because you're expecting lower prices based on your higher time frame schematic, which is based on lower time frame schematic entries, which is now based off of an even lower schematic entry, right? So you shouldn't be already expecting accumulation or reaccumulation, but instead you are already preemptively, based on order flow and based on previous Wyckoffs and based on previous candlestick structure and unmitigated supply zones, expecting price to break down. So that is why reaccumulation, redistribution, and volume are not a necessity in understanding Wyckoff, because Wyckoff can present itself and it can be read by way of overall mitigation, by way of how price is breaking, how price is liquidating, and how price is moving in terms of the type 1 and type 2 schematics in a certain area where you're expecting mitigation. So hopefully this made sense, guys. Thank you so much for watching, and I will see you guys in the next one.